Imagine this. You're standing on the edge of a vast ocean with waves of financial opportunity crashing around you. But there's a catch. You need the right surfboard to ride those waves to success. In the realm of personal finance, your credit score is that surfboard, enabling you to catch the biggest and most exhilarating waves towards your financial goals. Today, we're going to unlock the power of credit scores and set you on a thrilling path to financial freedom. What is a credit score? Put simply, your credit score is a 3-digit number that indicates how reliable you are at borrowing and repaying money, ranging from very poor to excellent. Sort of like a financial report card summarizing your credit worthiness in a 3-digit number. It might sound daunting at first, but it's merely the culmination of your financial decisions, past borrowing behavior, and payment history. Lenders will view you as less risky if you have a higher credit score. So, if you're hoping to get a new credit card, apply for a loan, or even a mortgage, good news is that you'll have a good score. You're more likely to be accepted and given better rates if you have a good or even excellent credit score, regardless of what you need credit for. Factors that affect your credit score. Payment history. Your payment history forms the basis of your credit score and is taken into account heavily by creditors and lenders when determining your credit worthiness. Maintaining a healthy credit score and establishing a strong financial base both depend on demonstrating a strong payment history. A strong payment history opens doors to better credit opportunities. Lenders are more likely to extend credit to individuals with a track record of timely payments, offering favorable interest rates, higher credit limits, and more attractive loan terms. Consequences of late payments and defaults. Late payments and defaults can have severe consequences on your credit score and overall financial well-being. Each late payment gets reported to credit bureaus and stays on your credit report for up to 6 years. This can lower your credit score and make it challenging to access credit in the future. Increased interest rates. Late payments may trigger penalty fees and increase the interest rates on your credit accounts. Higher interest rates means you'll end up paying more for credit and potentially accumulating more debt. Difficulty renting or leasing. Late payments can also impact non-credit related aspects of your life. Landlords and leasing companies often check credit history when evaluating rental applications. Consistently late payments could lead to rejections or require larger security deposits. This is why it's so integral to understand the importance of making payments on time and the potential consequences of late payments. By prioritizing timely payments, you'll safeguard your credit score, maintain positive relationships with creditors, and open doors to a brighter financial future. One effective way to ensure timely payments is by setting up direct debits or automatic payments. By authorizing your creditors to automatically deduct the payment from your bank account on the due date, you eliminate the risk of forgetting or missing a payment. Direct debits provide convenience and peace of mind, ensuring that your bills are paid on time consistently. Remember, it's never too late to start building a strong payment history and taking control of your financial well-being. Credit utilization. Credit utilization is an important factor because it shows how responsibly you manage your available credit. High credit utilization, where you've used a large percentage of your available credit, can negatively impact your credit score. This is because it suggests that you may be relying heavily on credit and potentially facing financial strain. To maintain a healthy credit score, it's generally recommended to keep your credit utilization below 30%. In other words, if you have a total credit limit of £10,000, you should aim to keep your outstanding balances below £3,000. When you have a low credit utilization rate, it demonstrates that you're using credit responsibly and within your means. This can positively impact your credit score and signal to lenders that you're a low-risk borrower. Longer credit history. The length of your credit history plays a role in determining your credit score. It provides a track record for lenders to assess your creditworthiness and financial responsibility over time. The more years you have of responsibly managing credit accounts, the more confidence lenders have in your ability to handle new credit obligations. On the other hand, a short credit history can make it harder for lenders to gauge your creditworthiness accurately. They may be more cautious in extending credit or offer less favorable terms due to the limited information available. It's important to note that a longer credit history doesn't guarantee a better credit score. It's the combination of a long credit history with responsible credit management that contributes to a positive impact on your credit score. To maximize the benefits of your credit history, it's crucial to maintain good credit habits consistently. Make timely payments, keep credit utilization low, and avoid excessive debt. Open credit accounts and use them responsibly. For those fairly new to credit cards, make small, manageable purchases and pay them off in full each month to demonstrate your credit worthiness. Inquiries on your credit report. Recent inquiries on your credit report can have an impact on your credit score. When you apply for new credit, such as a credit card or loan, a hard inquiry is generated on your credit report. Whilst a single hard inquiry typically has a minimal impact on your credit score, multiple hard inquiries within a short period of time can lower your score temporarily and may signal to lenders that you're actively seeking credit, which can be seen as a potential risk. It's important to manage inquiries by applying for new credit only when necessary. Soft inquiries, such as checking your own credit or pre-approved credit offers, do not impact your credit score. To minimize the impact of inquiries, be strategic in your credit applications. Only apply for credit when you genuinely need it and have researched the best options for your financial situation. By managing inquiries and being mindful of how they affect your credit score, you can maintain a healthy credit profile and increase your chances of obtaining credit on favorable terms. Monitoring your credit reports is essential for identifying errors, inaccuracies, or signs of fraudulent activity. Obtain free copies of your reports from the major credit bureaus annually and review them for any discrepancies that could affect your score. By following these tips and maintaining good credit habits, you can improve and sustain a healthy credit score over time. Remember that building credit takes patience and consistency, but the benefits of a strong credit profile are definitely worth the effort. If you enjoyed this video, please give it a thumbs up and subscribe to the channel. Also, hit the notification bell to receive updates on new videos. Thank you for watching and stay tuned for more financial insights.